Welcome to What's the Risk, hosted by myself, Daniel Crowe, and Peter Mancell, founder of Mancell Financial Group, a financial advice business he founded in 1980. This is a simple video series we hope investors can use to better understand index and portfolio performance, along with addressing some investment questions and dilemmas. Now, this episode is on the importance of having investment beliefs. Now, you might be wondering what we're talking about. Well, this is your money, and if you want to manage it, you should have a solid set of beliefs you can refer to and rely on to firstly protect your money, but also ensure when things aren't favourable, you can justify the decisions that you've made. Your Investment Philosophy, book we wrote, shameless plug, available at Amazon. Disclaimer, please pause and read. Suffice to say, our intent is educational and not rendering financial advice. Don't make a step to sign. These are simple concepts, not suggesting people take more or less risk, just they understand risk. I saw this tweet recently from investment manager Cliff Asness, and Cliff's got some opinions. He's unafraid of sharing them, and he's someone with definite investment beliefs. Now, whether you agree with him or not, he can say this is why I do what I do. And in this instance, he said that BlackRock is a brokerage, not an investment shop. And this was in response to the BlackRock CIO saying that you should include Bitcoin in your portfolio. Now, someone asked Cliff what he meant by this, and he said they don't have investment views. They'll sell you anything you want and buy anything you want for a fee. So if you're offering Bitcoin to commodities to residential real estate ETFs, which BlackRock does, I think that's probably a fair assessment, Peter.
Absolutely. At the end of the day, as an organisation, they are prepared to let you buy anything that you're willing to buy. They don't act for the investor. They just produce a product of some description that they promote for you to buy, and they get paid for you doing that. They're not working for you.
And a reminder on this, definite legitimate companies, and there's nothing wrong with this. It's just a reminder that because a fund manager offers a product, it doesn't mean that you need to use it. And having investment beliefs will give you a better chance of knowing what products are actually right for you.
Over 4.5 decades, I've seen an incredible number of products designed, come and go. What investors should be investing is in other products that suit their particular needs, goals and objectives. Don't buy products that are promoted to you by someone who's got a financial interest in selling you that product.
Yeah, a bit of a famous scene here just to underline what we're talking about.
Speculating that the price of gold will rise in the future, and we have other clients who are speculating that the price of gold is going to fall. They place their orders with us, and we buy or sell their gold for them.
Tell them the good part.
The good part, William, is that no matter whether our clients make money or lose money, Duke and Duke get the commissions.
Well, what do you think, Valentine?
Well, it sounds to me like you guys are a couple of bookies.
Yeah, pretty much. If an investment manager, most of them don't necessarily care what your objectives are as long as you're going to pay the fee on their product.
Absolutely. And it's absolutely essential that investors understand that. It's not about whether the product is right for you. It's about whether you using the product is right for their shareholders.
A little bit of a segue here. This brings us to Jeremiah the Bull Evans. So this is a guy who went viral a couple of years ago for hosting a conference in Utah with a bunch of manosphere type guys. It was called AlphaCon, and his tag was "Be Great or Be Nothing." And it did turn into a very big AlphaCon because he got done for fraud, pled guilty, and got 8 years in prison. He was selling investments in his company. I believe it was an internet marketing type company where he was selling things and claiming that he had a very high rate of profit, and there was none really to speak of. And among other things, he was taking money out of the company to buy a Lamborghini. So I'm just going to say it's notable in this case that it happened in Utah.
Yeah, it doesn't matter really whether it happens in Utah or anywhere, but scams and Ponzi schemes of this nature are very sad. It's sad when investors, get hurt by this sort of behaviour, but it is certainly interesting that it did happen in Utah.
So the next question is, well, what's up with Utah? And the Salt Lake City Tribune, which is the newspaper in the capital city of Utah, says it's a state with a long-held reputation as a fraud capital and a population that lives there that's considered uniquely vulnerable to swindlers. Now, these are just a selection of some investment schemes that have gone on over the years there. Now, it started off with uranium interest during the Cold War, then it went to precious metals. Some scammers there told people they were running mines and they would mine silver and then they'd hold the silver while it appreciated. Now, of course, no mining was actually going on. There was no silver to be found. They were just taking people's money. A little bit of a funny one here. The first time I've heard of beaver farming. So apparently, but it plays into the agricultural schemes that you see from time to time. Apparently, people were saying that they would raise beavers and just,
Oh,
yeah,
I've got to
raise.
say, when I first saw this, I thought to myself, good Lord, I've seen some incredibly strange agricultural investment schemes over the years. Here in Australia, I remember all too well in the early 80s when ostriches were going to be the next big thing.
Yep.
But when I saw beavers on the chart earlier, I did have a bit of a chuckle to myself. A beaver's not that big a creature. And yes, a beaver pelt's probably a great water retardant, natural skin. Feel sorry for the beaver. It's pretty hefty commitment it makes to give the pelt up. Yeah, I just can't see how a thinking human being could even look at those words beaver pelt farming and think that it could be legitimate. It just leaves me completely perplexed.
Yeah, well, that one did turn out to be another scam. And then in the 1970s, there was a pretty big penny stock boom in the US, and Newsweek called Salt Lake City the sewer of the securities industry. And since then, since 2000s, it's been more Ponzi's and the internet's played a role in it. And as of late, crypto then made its appearance in Utah. Safe Moon was a pretty big crypto scam that was blow up out of Utah. I guess what's up with Utah again? Religion plays a part in this. We're not potting religion, or it's nothing to do with Mormons specifically, but what happens if you don't have investment beliefs? And the thing is, you're going to rely on the next thing that you have a strong belief in to judge something by. And if a person can launder their investment through something else that you trust, like your religion, it's a shortcut to your money, especially if you have no other reliable way to judge. And in the past, the president of Brigham Young University has come out and spoken about this, and it even makes mention in the Church of Jesus Christ of Latter-day Saints General Handbook about affinity fraud, where people use religion to try and con people out of their money. And it happens with other religions too, but it's very specific in this case to Utah, and we can use these examples to highlight it. And I guess, Petey, I could say to you too, I recall you once telling me about a client selling a business and they were approached by someone in their own church to invest in something.
Yeah, absolutely true, and certainly not related to the Mormon Church. So again, not wanting to portray them as in any way
No.
improper, but this particular client did actually sell a substantial business to a publicly listed company, and within a heartbeat, a member of the church was trying to promote to our client that they should invest a significant sum into a tax-driven agricultural project in citrus fruits. Now, Australia as a country has had orange and lemon groves and all manner of citrus fruit trees for decades and decades. So, the first thing is, why would this project be any more successful than all of the existing citrus fruit businesses that have been around for decades? Secondly, if it's such a good investment, why did it have to be tax driven, where what was actually happening was the investor's capital was actually being spent on expenses to run the plantations, and that's the only reason they were getting tax deductions for it? Well, the bottom line was the client listened, accepted that there were risks that they really didn't want to take, and chose not to invest. And in less than a year, that scheme had failed. And those that had invested lost everything.
So the absence of investment belief. So you cannot substitute something else for investment beliefs. So they are the pillars that protect your money. So you can't, if I don't know anything about investing, you cannot use religion, politics, culture, your favorite sports team, an affinity with a brand, a company, a celebrity, the supernatural. These are things that cannot reliably guide investment decisions. And if you're reaching for something else to filter your investment decisions through, it's not a reliable way to find and come to an investment conclusion about whether something is worth investing in.
Absolutely. I've said for many, many decades now that investing and emotion should never be mixed. They should be kept completely apart. And if you look at the words just chosen by you, in that last sentence there, religion in those that believe evokes a really strong emotional response. The opposite side of your political views evokes a strong emotional response. Your favourite sport team, whether they're winning or losing, evokes a strong emotional response. A love for a particular brand or the admiration of a particular celebrity apart. You're more likely to keep more of the second. Emotion, money, keep them apart. You're more likely to keep more of the second, and you can do what you like with your emotions, but don't mix it with your money.
And the reason we bring up celebrity and sports teams there's been a lot of notable celebrity or sports people spruiking things that they didn't necessarily understand, but because they were the front man for it, the potential investor who didn't know anything or didn't have any investment beliefs, or, well, hey, if the opening batsman for Australia for the last decades promoting this whiskey or something else, that must be pretty reliable, and it's certainly not the case. Investment beliefs help you filter. So there's scams and then there are genuine investment products. And often you'll hear investors who've lost money to scams say they might have a university degree or they've worked in a certain field, and it gives the impression that the scam was something sophisticated and it got past them. But the first question you'd really have to ask these people is, did they have any investment beliefs? Because if they didn't, that's probably why it got past them, not because it was so sophisticated that they were an accountant or they had a PhD in some science or something like that. So having investment beliefs ensures you avoid the scams totally, which is the first thing you want to do. Then you're able to filter the legitimate investment products out there down to the very small number that might suit your needs.
Absolutely. If we just start with something as simple in investment beliefs as believing in Bill Sharp's Nobel Prize winning work, that risk and reward are related. So as soon as anything promises you a really high return with supposedly low risk, your investment belief should say, well, that can't come true, so I'm going to avoid that. What is it that's got a risk characteristic that I'm happy to tolerate? Now I'll look for the investments that fit within that framework of risk and reward, and look for the investment products that will then suit my time horizon, my spending objectives, etc.
And why do you need to filter legitimate investment products? We understand why we need to filter scams out, but you'll often find that products and managers, you need to find ones that align with your beliefs. And these are a couple of slides that we've used before. If managers just want to sell you something, it means they're unlikely to have a strong commitment to whatever they've got out there. So in this case, we've shown you before, index managers will change benchmarks and chase fads at a drop of a hat. And in another case, index managers or fund managers will drop funds at the drop of a hat that they just have no commitment to.
I've watched over 4.5 decades, a new product will be launched by an institution that they supposedly have strong conviction in. But when it doesn't sell, they wind it up and it's gone. And those investors that did take the risk are often the unwitting victims of a poor outcome. I recall distinctly a time back in the early 80s when interest rates were very high, and one of Australia's major banks launched a capital guaranteed share market fund. They were absolutely certain that they were on a winner, and that was that interest rates were about 16% at the time. Share markets were booming in the early 80s before the 87 crash. They would take 97% of the fund and invest it in cash. Now, when you're earning 16% per annum, by the end of the first quarter, you had about 3.3% of your original capital in the form of interest payments, and the other 3% of the capital, they bought share options, literally betting on the direction the share market would go for the 3-month period. If they made more correct bets than incorrect bets, the fund technically was going to make money. There was only one problem. Interest rates started to fall. So quarterly, instead of having 3% of the fund's assets to bet on share options, 3 became 2.5, became 2, became 1.5, became 1. The fund was completely unviable because interest rates had fallen, management fees still had to come out. There was no money to buy options. That bank closed that fund down with very little money in it and very little success to chalk up on the board.
And finally, sources and descriptions of data. Thanks for your time.
Bye for now.